None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good afternoon on the East Coast and on the West Coast. Those of us out here on the West Coast, good morning yet. Excited about doing this call today. We finished our outlook for 2016 and released it a little bit over a week ago, and want to go through a lot of details and some of the research that came in on when I was doing this. There's so much more than would have had to write a book about everything that's going on right now. And the whole idea of the uncharted territory is where we are today. And you know, I've been doing this for 37 years. I've watched interest rates go from 20% to zero, and I always said they could never go below zero. That's a good thing about interest rates. Well, we now know the academians have now all tricked the entire planet of taking negative rates. And of course, what's happened in Japan in the last couple weeks, and it just goes on, and they're trying to expand the economies through negative rates. It's obviously not working. It's been a big house of cards that we've been dealing with. And what I want to do in this conference call today is really talk about all of the things that are happening, a little setup, and then we're going to go through different segments of the markets, talking about the world economies and the U.S. economy, and then going through all of these things. But you know, it's amazing times that we're in, because you can't believe what you see sometimes when you're going through things. And I'm going to go over to a screen here, and you're going to see I've got the U.S. debt clock up here. And one of the things, those of you that watch the Market Thunder Show a lot, we have a fair amount of guests today, and welcome to the show. We do this every Monday at noon Eastern time. We have a Market Thunder Show that we do for our clients. And today I'm going to be using our software. I'm going to be using TradeStation, which I've used for a very long time, and a number of other elements to be able to talk about what the markets are doing, what the expectations are going forward. And unfortunately, I wanted to open this up to a larger crowd of people, because the realities are we're at a very large turning point probably in this country and on the planet, and the things that we see going on. And you know, you can look at what's going on in Europe. You're seeing a complete invasion of Europe, and a cultural change, and lots of expenses that are going to be incurred long term, dealing with all the issues in Europe. Not to talk about, they've never really fixed their banking system. They've never actually fixed anything in Europe other than put patches on it. And of course, the ECB is in QE, while our guys here in the Fed is trying to get out of the game. And the realities is that the fundamentals that are behind the scenes, and I hope to be able to bring this into focus today, are not good. The expectations of what's going on in the markets have been built totally around this house of cards, or the Fed and the QE. So you have to ask yourself, how did we get to 2134 on the S&P 500 last year? Was it through fundamentals? Was it through a moderate 2% GDP growth? No. In the early stages of the rally in 09 through 11, we saw a lot of new efficiencies coming into companies. Then we saw this massive disruption with the European situation occur in 2011, and we emerged out of 2012 by central banks being in a concerted effort to expand asset prices. And it's been an amazing thing to watch. It was as amazing to watch this scenario happen as it was back in 1979 when I started in these markets and I saw the whole world collapsing in a different way where rates were going up. The Fed was trying to get the banks from trying to borrow money from the discount window by putting surcharges, and there was literally the short-term rates hit 20%, long-term bonds were between 16.5% to 17%, depending on maturity and the type of paper it was. There were some things above that, and then we see a major, bull market and bonds start from there, which would make sense, right? So we went in the last 30 some years, we went from basically 20 to 0, and the whole effort that we've seen here has been unprecedented. We've seen a huge expansion of debt. And you can see here I have the debt clock on. We're at 19 trillion. And if you go back and mark, it's almost to the day. And I've talked about this on our weekly Market Thunder show, which I think we've done about 150 shows now, is that once the debt clock hit 18 trillion, the market stopped going up. All of a sudden, and I've been talking about this for a while, there's some number out there that everybody wakes up and go, this is not sustainable. And I've been saying, is it 18 trillion, 19 trillion, 20? What's the number? There's a number. And 18 so far, the stock markets are starting to falter from there. In spite of all this massive buildup in debt, and I'm going to go through treasuries here in a little bit, we see this huge demand for sovereign debt, and it really is scared money. It's all the money that's going into sovereign debt, and especially the U.S., is looking for whatever little yield there is, and it's all scared money. So as we look at the entire global situation that we have here, we've got a lot of scenarios going on. We've got the European situation, which is getting, I think, in the background, there's a lot of tension building. Financial tension is going to continue to build over there, and no one knows really how this whole thing's going to play out when you take millions of people and throw them into another culture, and then you're trying to I guess integrate them into your economies. It's one thing. Right now, it appears that the refugees are on a handout basis, so they have to be supported. So it's going to be really interesting watching that. Then let's go to we'll start kind of there and go to China. We look at China. China is imploding because they're trying to make this massive switch between where they are now, being a manufacturing community, and go to a service and a demand economy so they could be self-sustaining. No doubt, best strategy, but it's going to take 10, 20 years or more to actually get this converted. While that's happening, they have a lot of risk that they're taking on to be able to make that transition. And through this risk, we've seen them devalue their currency back in August. All of us remember the big sharp decline that we had in August. Well, that was based upon the entire backdrop of the beginning of currency wars. And so when they started to drop that currency, obviously it affected all the asset prices on the planet. And I mentioned in our commentary on Monday, one of the things you need to watch out for is that the Chinese situation is going to be dominant, and it has a lot to do with their shadow banking system and the currency. And what they need to do, they need to devalue the yuan much more to get it to the point where they will become more competitive as far as things go, to keep some of the things going domestically as well as the exports still flowing. And it's the whole effort. Right now it's around 6.5 and change. I think we're going to see the yuan at 7 or 7.5. I spent about a month in China about 10 years ago, and it was 8.50 or 8.70, almost 9, I think, at the time. So there's been a huge appreciation. Now they're trying to get back to a point where that's going. If you look at what China's done, and I'm going to tie Japan in next, but China has supported their stock market. We know they froze stocks when the market started going down. They froze stocks and stopped them from trading. They have been buying billions of dollars of stocks to support the markets, and that's how bad things are that they have to go in and support the assets. So a quick switch over to Japan. Most of you may or may not know this, but the the Bank of Japan actually owns 50% of all the ETFs in the main market indices in Japan, meaning things are so bad there, they've been buying assets to prop them up. You realize that if they had not done that, all of these markets everywhere around the planet would be collapsing. And I plan on showing you here a little bit ago in a little bit that the dry ship index, there's a huge crisis going on in demand. The demand equation is collapsing. There's no demand. And I'm going to touch on going through commodities and all that as we go through the different sections of the report that we did. But just trying to do a more in-depth overview of what's going on the big scene of things. So we can't forget what's going on in the Middle East. We see all kinds of disruption there. We'll go into crude oil and the commodity sector, but obviously there's a lot of pressures across the board in crude oil, which is causing lots of banking pressures and everything else. I've heard so many times that people are not concerned about the banking system. We're not in a 2008 scenario. Actually, I'm going to tell you, I think we're in a much worse situation because of all the debts that have been built up. The sovereign debt's high demand, but we've seen corporate debt, the emerging market debt. All of this stuff is adding up huge pressure. And when you see probably the biggest relief in what we saw, the rally that we saw, the recovery rally we saw yesterday, was because the U.S. dollar took a hit. So we're going to go through all these elements as far as these different markets. But the setup is that the world economies are in disarray. They are not good. The Fed will not be able to change anything. In fact, if they get too dovish, a good example is markets I haven't looked at it for a few minutes, but it was hovering around unchanged up a little bit, but we're still down quite a bit in the last several days. But there's nothing if the Fed comes out and says they need to do QE4, it will panic the market because everybody will know at that point that things are really, really bad. It's just like the Japanese that came in the other day and announced that they're going to do negative interest rates. You've seen stories, they're flying stories out right now about the Fed talking about going negative interest rates. Why anyone would go negative, I don't know. You can look at what's happened in Switzerland and Germany. I think the Bund was close to it, but in Switzerland, it's probably the best. As you can go to a 10-year maturity, and under that, you go all the way out to 10 years, and you're still negative. I think you're negative by 0.2 or 3 and so you're seeing, but the economies aren't expanding. There's no benefit to the actual economy, and the central bankers have gotten so deep into this strategy that there's no turning out. Those of you that have been around us for a lot of years, in 2010 I had a guy named Hugh Hendry come to our national conference, and Hugh was talking about how the Japanese in particular, but that we were all going to turn Japanese eventually and have to go through the same scenario. Well, the Japanese would go nuclear, meaning they will go to any lengths to support this strategy they've got out there. And now, at some stage you're at the final leg where you see the nuclear strategy and then you don't get much of a bounce out of here. But going back to our debt clock I have here real quick, and then I'm going to move on and we're going to start going through some of the long-term technicals. This is not going to be a typical market thunder meeting and where you have where I'm going to go through all the steps in the current market situation. We're going to focus today on long-term only. So let's go ahead and get over to the charts then. And one of the places I want to start here is looking at the Dow Jones. And I'm going to go off screen here just so that you can see exactly what this chart's doing. This chart I have here goes back to around the 1950s. It's the S&P 500. And it amazes me that folks will talk about this market's just going to go up and up forever. I want you to look at the tremendous volatility that we've had as far as this big swings. This was the 2000 high. I'm going to go over here and put a whiteboard up so I can so I can show you exactly. I'm going to draw some lines on here so you can see this on a whiteboard. And this whole rally that we saw, believe it or not, this right here is the 1987 crash, which was a 40% decline. You can see what we've done since then. This move here is what is, from an Elliott wave viewpoint, is a wave 3. And then we have this huge ABC pattern, and then this was the what I believe to be the final leg up on. And I can go back and bring up a Dow Jones chart. We can go all the way back into the 1920s. It has the same basic formations from around the 1960s forward. Is that this is like a 100-year flood chart. This is the end of a major sequence. It could be, as we see, and I don't want to get too political or too, I guess, talking about some conspiracy theory, but this is what would be the peak of possibly of society as we know it, and that the assets and everything, ultimately, this thing needs to be reset to a realistic level. If you go back to 1929 and to 1933, the market reset by 87% of its value. I'm not suggesting that right now, but what I am suggesting is that we could see markets decline. My initial expectation is that the market is going to decline to around the old highs of back here in 2000 and 2007, back to 1575. We'll probably get some kind of move like here. And then once this is done, this is not going to be a straight line. I think ultimately, depending on how much time goes, these are multiple years here, we end up back at maybe the 1260 level. This is discussed in the report, the 1260 level, to possibly going all the way back down to the 1010 level, which is going to be right here. This was July of 2010, and then of course the old lows were at the 660 level. So I don't expect this to go all the way back, but I know there's a lot of lines on here, but I do expect to see at least a 24 to 36 month decline, which will have been signaled going back to July of last year. So we're getting multiple months into this pattern right now. I'm going to clear off all the lines here. This high that was reached last year is likely to be a high for at least 3 years. And then ultimately, depending on how this thing flows, and when making long-term forecasts, you have to let things unfold to update the forecast. So next year, this time, we're going to know exactly how this thing's unfolding. But everything is pointing to this event, which is a monster decline, which is going to ultimately bring this market down at least to 1575. My expectations are down into the 13 handle, maybe all the way down to 1010. And it really comes to the point where we're at this tipping point now where everybody's starting to realize, I had the debt clock up a minute ago, that 19 trillion, we're going to be at 20 trillion no matter what happens by the end of the year. We're going to hit maybe 22, 23 a year and change from now. 22 probably about a year, and like within a year and a half we're going to be at $23 trillion. And that's not even talking about unfunded type situation as far as unfunded liabilities as well. That's in 100 trillions. There is no way to, all that they can do right now is to manage the debt. They really can't pay it down. We're already hit the tipping point, at the point of no return. So asset prices ultimately are going to have to be adjusted. It is my opinion, of course, that this entire rally that we saw from this low here on, let me just get the whiteboard up again. This last leg of the rally here has all been induced through QE of some form, going back to the TARP program. And this entire thing has been inflated magically. pretty much done the same thing on real estate. The goals of the Federal Reserve was to fix the last crisis, so they pumped up these assets. Now what we're looking at is a lot of other issues, such as there's no demand for any products. That's why you see commodities and things going on, which I'll cover here very shortly. But this event is really what's going to be causing this configuration to unfold. And this is probably what we're going to see, these three lines down, coming down into the 1360, 1220 level over the next 24 to 36 months. I suspect we will get some sort of rally. If there was some kind of black swan event or something that were to happen, then possibly you could see, the classic. Matter of fact, if we brought up a Netflix chart, when it went up, the first time it went up 270%, it just collapsed all the way. It went from $60 to $270 back to $60. Sometimes these charts will do this. This is not my expectation. I'm more expecting a asset market that is being redistributed over time, which gives you that stair stepping down. And we've talked about this. So what do you do during this time? I've talked to advisors about this quite a bit. Is what do you do during a period of time like this, if I'm right, and this is 24, 36 months or multiple years where there are bear markets going on? We at VPM Partners are really working hard to come up with strategies that we're going to be able to, participate in some way, because it's really hard. Most people in the last 2 years have lost money for their clients, and they've started off this year. If they're not using VPM, we've been 100% in cash on most of our strategies before around November to December. We were out, so most of those strategies are not down at all. My joke is there's no bear market at VPM Partners. On equity strategies, we still have some exposure, but it's pretty lean. I'm going to show you a couple things here in a minute to show you how little of the market is actually participating, has been participating for the last couple of years. But these scenarios that I'm talking about here on the S&P are huge. This is, and I'm spending a lot of time on this because this is the main backdrop of what we need to be aware of. So let's move on. I've got some short-term graphs here, but what I want to do is we're going to go through and look at crude oil first. So we're going to go to commodities, and then we're going to do interest rates, and then currencies, probably finish there. So we'll go ahead and hit the commodities. I'm going to a long-term monthly graph here, and of course you can see it's over my head. I'm gonna get to a different chart here. Bear with me 1 second. So this will give you a little better perspective. This is the monthly graph on crude oil. Now, I've been around so long, I've seen crude oil under $10 once upon a time, going back in the 80s. And we're seeing from a standpoint, this is a continuous chart which has all the premiums and everything built in on the rollovers and everything. And technically speaking, if I went way back, we were actually on a relative level making new lows from a valuation. But you can see this monthly graph, even though we're looking at prices collapsing and we're at $32 on the near contract, on the spot contract, you can see these trends are sharply down, and I've talked about this a lot. This is a monthly or a secular trend. This is going to take probably anywhere from, let's say we bottomed already, let's say 29.40 the other day, or whatever number you want to pick off one contract that went down to 26.70. That is, let's say that's the low. It's going to take at least 4 to 6 months. This thing's going to go sideways, and the only thing that caused the rally in the last couple of days is the collapse in the U.S. dollar from its highs, and that's caused a reevaluation from a dollar viewpoint. But the fundamentals haven't changed. And that was in spite of, I think, a 7.8 million buildup in the crude and all their excesses they have. So you're looking at right here, this chart is whether it's bottomed or not. Let's say it's similar to what it did in '09. In '09, it took probably about 14 months, and then it just went sideways, and now we've collapsed to the next level. So getting back to even think about getting back to $40 to $45 maybe is possible. Maybe that will save the banks, but the longer this thing stays under 40 down to 30, the more stress there's going to be on loans and the banking system and everything that happens here. This commodity is not going anywhere. So what I'm going to go to next, I'm going to go to copper. And copper has a little different look. It's not as negative. This is a more of a commercially that would reflect, I guess, what's going on in the economy. This has always been one of those that are commodities that have been looked at as an economic indicator. It's actually showing some pretty good bottoming pattern, but the bottom line is all of the trends are down, so it's not likely to go far for a long time, so demand's likely to stay very, very low. And this is important from the standpoint of understanding what the potential for economics are. And in China right now, they're buying everything they can find because they've got capital, and they're buying everything as cheap as they can right now. So at some point, is the world coming to an end? I don't think so. But the actual demand is actually been crushed substantially. So let's go and take a look at another commodity, which I think is as we talked about in the report, is that this is going to be a pretty big mover. For years, we have been really not a big fan of having gold in portfolios. We now think it's time to do that, and you need to have some allocation, whether you're using VPM or GLD or some sort of allocation to the metal now, because it's going to be, I think, a real positive mode. Looking for in a report for 1260, which is minimal, but back again up to around 1350 to 1425 is where we're going to be looking at this for gold to go to. And it's going to be, we've watched this thing all the way from 2011, where all of the risk I talked about earlier happened in the Europe and everything that happened then. That was kind of the turning point in gold. And since all that's happened and some, I guess, theoretically resolution with that, we've seen a drifting of this. We should now see a multi-year advance, which should coincide in a non-correlated way with the decline in stocks. We should see some money start to continue to flow into gold during this period of time. It hasn't been necessarily a great hedge, but the cycle is right, and you can see on our PPMs that I have over here, they've all turned around pretty substantially. So let's go through, because there's more to talk about on this stuff here. Bear with me 1 second. I want to bring up a chart here. I'm going to see if I can get this to work. Let me spread that out a little bit so you can see it. Let me get off chart here. So this, I want to back up just for a second because I meant to show this to you earlier. This is what the Chinese market looks like, and my expectation is that it's going to come back to the base. There's another 15-20% decline in the Chinese market, which is being, I think, is going to be reflected in the gold chart that we talked about. I think that They're going to continue to move assets around, and this thing is really pretty much out of control as far as that goes. But I wanted to make sure I got this on screen here so that you could see what this market looked like. So I apologize for jumping around there for a second. So I'm going to go back to the charts, and let's take. Matter of fact, it would be not fair if I didn't bring up the silver chart, and silver would be another commodity that I would say that you need to probably look at allocating to. So there's going to be, for years, Mitch and I have talked to everybody, there hasn't been any real need for the last several years to have any alternative type strategies going on. And now I think the risk will rotate into real estate. Probably want to downsize real estate, and you want to go into different types of alternatives as far as these go. So you're just looking at the ebbs and flows of these markets, and just like with gold, this has been in a 5-year bear market, and it's bottoming now. So these are times that, it's the old adage, buy low, sell high. This is a buy low strategy. And when you start looking at all these other asset classes, whether they're stocks, real estate, other items there, are going to be at risk substantially going through the next 24, 36 months as these asset prices get shifted around. So as I said, next, and I'm not sure how long I'm going to get through all the things in the report, and we are going to open things up for questions if you want to use our Twitter account. That's VPM Connect, twitter.com/VPM Connect. You can send messages there or email to VPM support at VPMpartners.com. So you can do that too if you have any questions, and I'll be glad to cover some of those things, because I think it's we'll see what kind of response we get on this, but I think there's some really substantial things going on in the market. Those of you that think you can ride through this thing and see a bounce, and it's all going to be like it has been for the last several years, the bounce isn't going to work anymore. You see even today the bad news was good news. There's we got a 5-point bounce where 1918 we did trade all the way down to 1870, so the volatility has been huge, but there's no trends here. All the trends are down. So I'm going to I'll go through the commodities, and then when I do a summary here, I'll go back and I want to show you the database and some of the other risks that are out there. So let's go ahead and take a look at treasuries. And we'll look at the 10-year to start. And I have talked a lot about this chart on Market Thunder over the past several months. We've been going sideways. There's a couple key numbers I mentioned in the report. It's this low right here, which is going to be, let me just get to this low here, which is the 1.65 yield. If we were to go below that, that would suggest we would challenge these lows way back in 2012 when we were all the way down at the 1.4 level. The Fed is talking about the potential of going into negative yields. It boggles my mind why they would say that, because I guess it's the same thing. Hugh Hendry was right back in 2010. We're becoming Japanese. Everybody has to follow it. The Swiss actually went the deepest first. The Germans had already done that on the Bunds. And then, of course, now the JGBs, the Japanese bonds, are working their way into negative. I think the 10-year, I'm not sure where it is right now, it was at 0.06, so it was right on the edge of going negative. And there's no economic benefit, as we've talked about. So this yields, there's a couple things on this page, and I reference these in the report, is there's some Fibonacci objectives for the rates to go up to around 307 to the 380 level. And those are still valid on the books, but it's a typical phase of the market where things that got pressed down. There's so much scared money. And let's face it, at 189 sounds a lot better than minus 0.25 on some of these Swiss bonds. So you're going to buy U.S. bonds. The amazing thing is that all the surge that was going on bonds that the Dow managed to get hit yesterday. So we'll look at that in a minute as well. But this whole scenario that we see happening here on the 10-year is setting up a pattern which I believe to be a bottoming pattern, which means yields are going to go higher. Now this is the secular chart or a monthly graph, so it's a very long graph. We're looking back to 1997, and you're seeing that all the momentum has been up on the PPM3, which tells me there's some pretty good upward pressure, but we're still neutral to down on the other two trend modes. So we're still trying to work this thing out. It may be another several months before we get down there. I think the low that we hit yesterday was 1.793. So we're seeing a little bit of bounce back to 1.86, but there's big resistance at 240. But this market ultimately should start to appreciate, and it's going to be interesting how this unfolds. This would be probably everybody on the planet has been saying yields are going to rise for the last couple of years. When we go back to the taper tantrum, you all recall that number, and now we got up to the right at the 3% level then, and now we backed off that. So there's a lot of work to do, and maybe in the end it doesn't matter because this is the safe haven money that we're seeing in here. Regardless of that, it seems to be staying up. So a couple things talking about what the Fed did. When the Fed decided to raise rates, they used a term that they talked about neutral Fed funds. And they didn't mention it in their last minutes, but I think they will use it when they need it. So they could raise rates 0.25% here and there. They're not going to be material other than they need to get rates up, because when you see the Fed and the ECB and all these other central banks and they're going, well, there's no need to do anything right now, we feel it's okay, that's because there's really nothing they can do. And the only thing, if they do certain things, it's going to panic the markets, making them realize how bad things really are. So the result of all of this is going to be, in the end, is a flattening of the yield curve. You can see the short end move up as they keep bumping these up. They're going to bump them up and say, don't worry about it because these are neutral rates. They're not going to be a problem. And then if you go from, if we go from that neutral rate syndrome, then they're going to start inching us up. They need some cushion if they do need to try to stimulate the economy, but you have to look at what's happened. Has it really stimulated the economy? Our last GDP was at 0.7. So there's no stimulus happening. We saw, reports come out today. Manufacturing continues to contract. Everything continues to contract. There's nothing going on. All the pundits are saying that there's no recession. There's nothing going on. There is a recession actually already from a demand standpoint, and we're just seeing this gradual unfolding of the markets realizing that the QE is coming out and all of these markets need to be adjusted. Now, on the interest rates that we're talking about right now, this market's being driven by safe haven money, and that's why you see the big bid in the bonds, and they're going to continue to flow in there. When you start to look at high yield and some of the other elements, you don't really see that same scenario. You see a lot of pressure, and we've talked about this an awful lot. I think I have it loaded up. So if I go over here, I want to show you. I want to go over to VPM real quick, and I want to show you on the bond side. One of the things that we've done over the last several years, we have some cash reserves, and we use municipal bonds to go through these. So I'm going to I'll bring up our USA cash reserve, and you're going to see this graph here. This is what muni bonds have been doing. They continue to do well. So if you use a managed bond like we have here, we've managed, it's close to a 45-degree angle that you can have here from this standpoint. But this is a selection of 4 or 5 of the top muni bond funds in the country. And this thing just keeps moving up. And we've had these out for about a year and a half, almost 2 years now. This is a place where you can park cash that doesn't want to have equity exposure right now. And will this continue to work? Not forever, but you can see when we protect the capital really well. So these flat lines here are when the markets are actually, we're going into cash and selling out some of these bonds. And then when the next trend comes, we're just stair-stepping this money forward. And it's a good place. The issue is if you have qualified money, you can't use this strategy. But for non-qualified money, it's quite good, actually. But the point of showing you that is that there's segments of other than treasuries that are actually working. When you start to get in to corporates and high yield, you see a much different story. And some of those things we've been out of, I think, since late 2014. So we've been out of those for a while because they've been under a lot of pressure. So anyway, I just wanted to point that out as we go through that, because it's important to see some of the different areas and what you can do with some of the money. As I kind of jumping around a little bit, but going back and referencing the outlook for equities is not a pretty picture, and it's not a pretty picture for the economy to continue to do that as well. It's just literally, this is a safe money trade right here. So having said that, let's bring the dollar up and get through some of these currencies real quick here as time keeps flowing. And I'm going to bring up the dollar index to start. And it's interesting because I have talked a lot about this and our commentary and the weekly show, and talking about the dollar expectation. There's still a really, really solid uptrend, although it's starting to fade. The short term has actually went into a neutral mode, and the intermediate and long term trends are still very, very positive. And the expectations are still for anywhere from about a 8 to about 14% increase in the value of the dollar. But we are going to see something, I think. I'm surprised that we broke back below some of the moving averages here, and we're heading down toward the key support here, which is going to be we're looking at around 92, 97. The index is 96. I actually don't think it's going to get much under 95, 90, 95, 50 at this particular point in time. And we're not likely to see much lower than that. This should stabilize. And since this, once again, is the secular long-term trends that we're looking at, this trend is very solid on a long-term basis. And we're most likely this middle line here. Let me blow this up, see if this works out for us a little bit. So this middle blue line is actually going to be the support line or the demand line for the dollar. So that's at 92, 97 and rising every month. So somewhere between where we are now and about another maybe 2 to 3% max on the downside, we're going to see the dollar supported again and working along this trend as we go forward. Ultimately, I expect it to get over 102 and run up to 106 to the 114 level. We'll watch this trend, but there's a substantial uptrend here. The PPM2 is at positive 1.05. Anything over 0.25 is a trend. So the probabilities of the market declining under this 92, 97 right now are almost nil. They're probably less than 10%. And if they did decline below those, they would be a buy, to say the least. So let's. So the dollar is in a sideways neutral mode right now. Probably a trading range. We could expand it to 94 to around 98. This thing goes sideways here and stabilizes. So you're not going to get a lot of benefit on the commodities and some of these other things from the weaker dollar. I think probably the hardest thing to put together this year is how these cash flows are going to work. And I still think out of equities, real estate, into metal, primary metal will be gold. I don't think there's going to be a play in the crude oil, but anything's possible. You could see production cuts, but you got Russia and you got countries that can't afford to stop pumping that, including here in the U.S. That's why we keep building these massive supplies, because they can't stop pumping. They need to pay their debt, so they got to sell it for whatever it is. You're better off losing money on some of this stuff and at least having cash flow. And ultimately, we know that's a dead-end street to get through. So let's see where I am on everything. Let me I'm going to actually bring up the report for a second and just take a look at that. I'm going to go off screen, and so we talked about the overview of what's going on. We discussed the economy, the market expectations. Here's the chart that I have here. You're looking at these levels. 1575 to 1450, I talked about that a little bit ago, is the expectation for the market to go down there. Support 2 is all the way down at the 1260 level. And we'll go through, I guess, as far as this support, and then all the way down, you can see, and this is a range of about ultimately 5 to 7 years if things happen on a orderly basis. This could actually decline substantially right away and go straight down to these numbers in a full-out collapse. We'll have to see how that plays out. And for now, and Treasury, as I said, I'm still looking for this thing as long as it holds 165 to end up at above. This is a long-term target. This is 2018-19. Looking at a couple years out, that we will see rates moving back into the 3.5, 380 range. And last here is crude oil. We talked about that in detail, and then currencies. And Mitch, can you hear me? Do we have any questions that have come up? I'll go field some of the questions, and that'll guide the rest of the show.
Yeah, one of the questions we got was in regards to timber as an alternative commodity.
Timber, you mean lumber?
Yes.
Okay. Interesting. That's actually a great question. I've always in the past, we've had this in our annual reports actually, and so the lumber is very similar looking to what we're seeing in as far as the copper almost. It looks the same way. We've been bottoming. I have always used this as an indicator for how housing's doing, and you can see that we had a blip up in 13, and then it's just kind of, there's not been a lot of demand for this. As far as, I don't know, is there an ETN or something that's tradable, Mitch, on that?
I'll have to look up.
Yeah, I don't know if there's something you can do. You certainly could put that in VPM if you're a current VPM customer. If you're not, set up a free trial, and we'll talk to you about some of the things that we can do. We've actually built 42 pre-built strategies that have a lot that can plug and play right into your practice. And we also have multi-variant models, which we have daily, weekly, monthly, and we have long-term models. We've done a lot of work over the last several years in modeling things. Most of our secular models, especially when it relates to the stock market, are currently out of the markets. But as far as lumber goes, I mean, it's certainly bottoming. There hasn't been a rally in this market forever. Since you go back, you can see this chart here, back to 05 and 6 when the housing maxed out. It's all the way down. So I wish I was trying to get.
There is an ETF. Ticker is CUT, C-U-T.
Okay, we'll take a look at that. So yeah, so let's put that up there and see what we come up with. I don't know how long it's been around. A great name for that thing.
2011 is when it started.
Yeah, there you go. So it's interesting because this is a monthly graph. Let's go into the intermediate graph here, and when you look at this, you can see this is interesting. This is in TradeStation, and this is actually the VPM logic, the buy sells. We actually have sell signals, and I guess if you're interested, we do have logic available you have to get TradeStation to be able to use it. But this actually has a short signal that came out back on a year ago, 12/11/15. Yeah, it wasn't a year ago. So in December, we have a sell signal on lumber, and you can see it's dropped down quite a bit. And so it could be a good place. I don't see it as an alternative. I think gold's going to be a play. This is going to be too economically related to this demand. And while I'm here, let me go over and do a DRYS, which is the dry ship index. This is nothing short of amazing. I'm going to take the strategy off just for a minute here, but you can see this thing has went to zero. It's actually up 2.7% today. It went, but it has been down as low as this index can go. You can see if we go back to 2014, this index was trading at $5 or $6. It's now at 12 cents, 12 and a half cents. So the cost, I saw that Amazon was getting into the shipping business, because why wouldn't you? It's free to ship anything. So they're getting into logistics and shipping as well now, because there's so much advantage of doing that. Is there any other questions, Mitch?
Just some clarification on those different levels for the S&P 500, the 1575 to 1260. What are your targets again for those?
Okay, let me just bring that up. I'll go back to the report here. Yeah, so the expectation here, I'll stay on screen, the first leg down, and I have these numbers, I believe, I think they're discussed here. You're looking at, of course, I was talking about the 1820 level. We actually penetrated that down. We went to 1812 just 2 weeks ago. We're trading about 100 points off that low, and we're 200 points off the highs right now. So we're down in the lower 30% of that range. And there's no way that 1812 is going to get away without being retested. But the expectation is for a minimum move down to around 1655. And then below that, the next level down will be where it's here, 1575 to 1450 will be the next range. Once this happens on commentary, I'll be able to zero this in. Once I see the patterns, I can get some finer tuned projections as far as it goes. Then ultimately, you're looking at 1265 to 11, I think it's 1195 range is the next range down. And this is over, like I said, 5 to 7 years would be a normal. We're looking at least, probably to get down to this 1450, we're probably looking at least down to, I'm gonna say at least into that 18 to 24 month range to get there. If it happens faster than that, then there's more serious issues that are emerging quicker, and then we get more into a 2008 mode as far as that goes. My expectation is we're more of a 2003 type pattern, where there's just stair-stepping down, adjustments going on in the economy. The evaluations that have been in the stocks are going to have to all be redone. We're seeing in the middle of earnings season now, we're still seeing a lot of misses. We're seeing the economy miss left and right, and it's just one of those things where this is going to be a continuing saga. And then we've got U.S. elections here that's throwing a lot of uncertainty into that as well. So the whole scenario is that this will be an elongated move. Anything else out there, Mitch?
That's all I got for right now.
Okay, so just let's summarize what we've talked about today. And I really didn't want to close that report out, but that's okay. One of the things I want to show you real quick, if we go to the home page in VPM 2.0, this is a pretty interesting chart to take a look at. And I'm also going to bring up the whiteboard here just so we can discuss this. Is one of the things that happens this is the 2012 rally here, and I want you to see what's happened here. And I was talking about somewhere right here where I'm putting this down arrow. This is where the markets, we started to hit that 18 trillion debt level. Everything started to flatten out, and since then we've just got a lot of noise in the markets. And so what we're looking at here, this is the S&P versus the percent long of our database. So we have 18,600 and change symbols in our database that we track. And I want you to see something here, and I've talked about this over the years. Each one of these since 2013, every time the market went higher, the percent bullish went down, or otherwise the participation. You have to realize that VPM is a trend follower, and so the trends, the uptrends of the stocks got lower and lower and lower, and you can't see it reflected right now. We're around 13.5% long on our whole database. So all the way back in 2013 is the peak participation. Since then, this stair-stepping by the dip rally has had fewer and fewer stocks actually participating. And I want to make a point of this because this is really important, is that that's why in the last 2 years you've had a lot of difficulty trying to do allocation strategies and try to make money in general because nothing is participating. You know, it's the FANGs, right? It's, you know, Facebook and Amazon and Google, Alphabet, whatever you want to call them. But all of these, and Netflix, so you're looking at a handful of stocks are driving market sentiment. There was a time when Apple was on board. I think we sold Apple, 127 and a half or something. We've been out of that thing since then. But the bottom line is, this is an illustration of why you're unable to make money in these markets. And especially when you start to break it down, if we didn't go through large, mid, and small, there's all types of things that we could talk about. But each asset class has been underperforming. In the last 2 years, it's been large cap, primarily growth, and anything else has been out of favor. The more you diversified in the last 2 years, the worse you did. It's been a time to be concentrated. In fact, when I showed you the muni bond strategy that we have, the best thing to have done in the last 3 years was to buy muni bonds in that managed situation, and you're looking at 7, 8 plus, almost compounding per year, just using municipal bonds. Not to mention you get tax-free income on that. Those are total returns that we have on those, right, Mitch?
Yes, sir.
Yeah. So I like to have the secret fly on the wall watching and being able to ask that. But anyway, the bottom line is this is I guess a perfect place to end. I want to keep this at an hour. The entire markets nothing is participating. We're looking at an unemployment rate at 5, but there's no participation. Everything is like this. There's no demand. None of this happens. And think about it, there's nothing that's going to stimulate or change this demand, that anybody can do. Current policies, the EPA, the Employment Prevention Agency, I like to call it, they're out there destroying industries, the coal industry, you name it. They're out there. There's all kinds of regulations that are coming in that have got this thing throttled down, including the Affordable Health Care Act. All of this stuff is just trolling the economy down, and there's no way to get out of the way. And with all the regulation, it's just it's like having a Ferrari, but it won't go more than 55. What was that Sammy Hagar song? I can't go 55. Well, this one you can't go over 55. So the bottom line is, you cannot see anything positive that's going to come out of these environments that are going to stimulate the market. I see these guys on my Twitter account. I hated to troll Bill Miller. He's been around for a long time, but he's down 20% already, and he said, but he's still bullish. It's laughable on how people are in this buy and hold mode, the passive allocation mode, that somehow they're going to get bailed out. This time, it's going to get ugly, and it's going to stay ugly for a long time, in my opinion. Anyway, folks, I so appreciate your time that you took out watching us today. And please send us feedback. You can use it on LinkedIn. I have quite a big following on LinkedIn as well as on Twitter. And certainly you can send us an email at support@vpmpartners.com. And if you have an interest in our services, just click on free trial. We'll be glad to work with you. We've had quite a bit of activity over the last several months with all the volatility of folks coming in. But we appreciate your time, and we will be, those of you that are subscribers, we'll see you on Market Thunder. If you have interest in seeing Market Thunder, send us an email. We'll tell you how you can do that. Thanks again.